Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Veraa. Few of the advisors who will listen to this podcast have had professional careers that spanned a period of rising interest rates. But rates have been rising, and passive allocations to bonds or to stocks cannot be counted on to provide the same results they did for the last 40 years. Given that regime change, my guest today is here to discuss what should be the appropriate allocation to fixed income in a multi-asset portfolio. We'll discuss how advisors should think about liquidity in their bond allocations and to what extent tactical adjustments will be needed. Karen Veraa, CFA, is Managing Director and the head of iShares U.S. Fixed Income Strategy within Blackrock's Indexed Fixed Income. She is a subject matter expert on fixed income ETFs and leads the commercialization efforts across the firm. As part of her role, she writes content on fixed income markets and ETFs, and she's been interviewed on CNBC, Bloomberg TV, BNN, and now on Gaining Perspective. So, Karen, tell me a little bit more about your career path, what led you to join BlackRock, and your role there.
Thanks so much, Bob, for having me on the podcast today. So I originally grew up in Texas and Louisiana, and I thought I was going to end up being a chemist or an engineer because that's what my dad did. But I just was gravitating more towards business, and I didn't really know much about it. My mom had become a financial advisor. She finished her college degree when I was 15 and then became a financial advisor. So I really learned about the industry through her starting her career after raising me and my sisters. So then I ended up getting a finance degree from the University of Texas, and I tried to consider going to New York City. So I went to New York, and it just seemed like a big place, really intimidating. So I didn't move to New York. Instead, I found a rotational analyst training program at the fourth largest bank in the country, which was Washington Mutual Bank, based in Seattle. If you know your financial history, we did not survive the banking crisis, the financial crisis, but it was a really great place to work. We were at the time a mortgage originator. We would originate mortgages. I learned a lot about banking and just retail banking as well as commercial banking and how mortgage-backed securities were created. And I ended up getting a job after that training program in the Treasury Department of the bank. And we would be trading short-term products. We would make sure the balance sheet of the bank balanced out. So we'd be borrowing money in the wholesale funding markets. That's really how I learned about fixed income. We would issue bonds, issue floating rate notes. I personally ran our Fed funds and repo book. So it was really a great way early in my career to really learn about fixed income markets. And that period spanned that Fed tightening cycle that happened in 2005 to 2007. So I would have to get up, at 3 a.m. when LIBOR would get set in London and try to reprice all my instruments for the day. So it was definitely an exciting time period and really learned about interest rate risk and what can happen. But the Fed at the time was very consistently raising the Fed funds rate 25 basis points each time. So for a lot of the market, it was at least predictable until they stopped. So the bank failed, and then I had gotten my CFA. So I went to go work for a registered investment advisor that managed portfolios for high net worth clients in the Seattle area. And that's really where I learned about mutual funds and ETFs, and decided after a couple of years of doing that, I'd like to get more into asset management. And I learned about iShares and Barclays Global Investors at the time. Tried to get my foot in the door, but they weren't hiring because they had just merged with Blackrock. And when the hiring freeze was up, I was actually able to get a job in the fixed income department doing strategy work. And I've been doing this ever since, and I just hit my 13th year with the company. So kind of a long-winded career journey, but that's really what led me to iShares and Blackrock, was just continually being interested in the fixed income markets.
Well, that's a distinguished career. Congratulations on 13 years. You sound like you're an expert on fixed income, and you've lived through a regime of rising rates. So before we talk about ETFs, I want to get your view of the economy and the business cycle. Let's start with a big fear that many people have, something that there'll be a recession, something that's already started. What do you and your team think about the odds of a recession in Q2 or later this year?
Typically, when we're in these types of cycles, that inverted yield curve, which is where the short term rates are actually higher than long term rates, is a pretty good predictor of a recession. It's sometimes wrong, but we really haven't seen, while the yield curve is signaling that, we're still at a pretty strong employment situation with 3.5% unemployment rate. The Fed is hiking rates to try to quell inflation. And we're still, even though they've been doing this through 2022 and 2023, we still haven't really seen it show up dramatically in the economic data. So the recession's not here yet. There is still that possibility. I don't have a probability, but we are watching metrics like bank loan officers, credit creation, not only the hard numbers like earnings reports. So we're getting mixed signals right now. So at this point, we're seeing the way advisors are reacting to the potential recession on the horizon is really sitting in a lot of cash. And now that yields are higher, people are really playing defensive. And I think what we'll see is as soon as the Fed pauses and as soon as we get clarification on that, we will see more money coming into the markets, stocks and bonds, because I think people are just really concerned about this recession and how hard or soft the Fed can engineer the landing.
So you mentioned that you think the Fed may pause. What are your expectations moving ahead for the Fed? Do you expect a pause for the remainder of the year, or will it at some point begin to lower rates?
Well, before Silicon Valley Bank failed in March, it was a pretty clear path. They were supposed to stop hiking. They were going to hike maybe throughout the rest of this year, maybe stop in the fall and then pause. And that's what was completely priced in. But I think now that we've had some weakness in the banking sector, that really acts and serves to reduce credit creation and almost pulled forward the pause in rate hikes. So where the market's pricing right now is a very low probability of the hike for the meeting in June, and maybe even a cut in July. Here at BlackRock, based on our BlackRock Investment Institute outlook, we don't think that they're going to be cutting later this year. I think they'll probably squeeze in one more hike here in a couple weeks at the end of June, mid-June. But that's probably where they're going to let things settle out. Inflation is still above their target. If you just look at the consumer price index, 4.9%, that's nowhere near their 2 to 2.5% range. So I think they're going to be trying to navigate this. How do they not cause a recession, crimp saving and spending, but at the same time, they need to do more to get inflation under control.
So you think that rates will be pretty steady from the Fed's point of view for the remainder of the year. But let's talk longer term. And I want to ask you about where you think interest rates are heading. But let's talk separately about real rates and then about inflation. 10-year tips right now are at about 1.5%, down slightly from 1.7% in the fourth quarter of last year, but still at 1.5% is a historically high level, at least over the last, say, decade and a half. Uh, Longer term, say over the next 5 years, what direction will real interest rates be heading? And then, along with that, what is your view on inflation and whether we'll ever get back to the 2% Fed target?
So real interest rates is primarily driven by the growth of the economy. So even I think what basically happened with us having a zero interest rate policy for so many years is it pushed those real levels of interest rates negative. And even though we didn't have negative GDP for the entire time, it was pushing it in that realm because the nominal rate, kind of think of it as like the regular treasury rate in the market, was so low. So when you back off that break even inflation number to get the real yield, it had been negative for quite some time. So I think the real yield's coming up to 1.7 is still implying relatively slow growth for the economy. And so we think that could rise a bit more just as we're still going to continue to have maybe 2 to 3% long-term growth for the U.S. economy, maybe even higher. So you could see those real levels of interest rates coming up. And then I think that break-even inflation is really a conundrum for investors right now. If we look at the consumer price index and some of the other core PCE metrics, they're trending much higher than break-even inflations. Think, 4%, almost 5% levels. Where the break-even numbers, which are just the difference between the nominal and the real yields, are still in that 2.5% range, just depending on the maturity of the bond. So what that tells me is that tips investors at least think that the market will get and the Fed will get inflation under control over a certain time horizon. So I think we're probably still in for some oversized consumer price index and core PCE prints as that inflation's trickling through the economy. However, the long term, the market thinks the Fed can get it under control just if you believe the bond market. At Blackrock, we think it's still going to be considerably higher than it had been in the past. Why we've had inflation of 1 to 2% really for the past decade. We think that over the coming near term, it could be more in that 3 to 4% range. So that has a lot of implications for portfolios. Your hurdle rate's going to be higher. You need to make sure that your cash savings is keeping up with inflation. And it may even force you to think of new sources of return. We've seen a lot of advisors even inquiring about alternative investments as a way to get more premiums back into portfolios. So I think it is tricky, but I think we're going to be in a higher inflationary regime. And I think we could see real yields rising, just getting to a more normalized level to match economic growth.
So it sounds like the big challenge, particularly for bond investors, is keeping up with and ideally staying ahead of inflation, which you believe and most of observers believe is still going to be higher than it has been historically, at least over the last 15 or so years. Let's talk about ETFs. Global bond ETFs asset under management is about 2 trillion. BlackRock actually predicted that we would reach that this year. What is driving the adoption of bond ETFs?
We're seeing all sorts of investors discovering bond ETFs for the first time or thinking of new ways to use them. So, as you've highlighted, the asset growth, we think by 2030, the entire industry is going to be up to $5 trillion. And a lot of that is coming on the back of a few different trends. Number one, changes in portfolio construction. We're seeing more financial advisors utilizing bond ETFs alongside active mutual funds as a way to reduce fees, as a way to control the exposures, and just build more efficient, scalable portfolios. So that's been a huge catalyst. We also see a lot of institutional investors using them for liquidity sleeves. So perhaps it's an insurance company that holds large amounts of individual bonds. They may also want to have something that they can trade and move around if they need to. So we see tickers like LQD, for example, being used by insurance companies, and we've worked a lot with that industry to get some look-through treatment, so it is more capital efficient for them to also use ETFs with bonds. And then I would say the final trend are just end investors. Everybody who has opened up a brokerage account is trying to think through how to get exposure in a low cost efficient way. And so we're seeing kind of the rise of the end investor, and the average person who maybe doesn't have a financial advisor doesn't know how to trade a bond. So they can access so many different cuts of the bond markets, duration cuts, credit quality cuts, and they can trade them just alongside any sophisticated fixed income manager. So I think some of these trends around portfolio construction and the rise of model portfolios, liquidity sleeves for institutions, and end investors really taking control of their portfolios are going to continue these trends for bond ETFs.
You mentioned LQD. Just to be clear, that is the iShares investment grade corporate bond ETF. Let's put this into practical terms for the advisors who'll be listening to this. What are you seeing at the moment in terms of what advisors are doing and how they are positioning portfolios for their clients?
Coming into 2023, we saw that the average financial advisor is underweight fixed income by about 9% of their portfolio. So if you're running a 60/40, let's say fixed income was that 40%, we saw the average allocation was more like 31%. And that's based off data. We have our BlackRock Advisor Center that you can put in a set of tickers. You can get some analytics on your portfolio. You can compare it to other portfolios you may be managing, or even model portfolios. And so we collate all that data. So we have data on over 5,000 portfolios that are real and actionable and managed. And I think that's really how people were dealing with the rising rate environment. Let's underweight fixed income. Let's go more towards equity risk. And so what we're seeing right now is people are overweight cash. That's been a big trend. We've seen a lot of money flowing into money market funds, sitting in bank deposit products with people questioning which banks they use. And so what we're seeing is this move, and the biggest question that advisors have come to us with is, how much duration should I have in my portfolio, and when should I add that duration back? And so we've just been helping people think through that if you're generally underweight fixed income, an easy way to do it is just getting your core bond weight back to that asset allocation target. With a fund like our iShares aggregate bond ETF AGG is probably it just costs 3 basis points. It's the entire taxable bond universe. And it's really that benchmark that a lot of CIOs use to set up their asset allocation framework. So we're seeing a lot of financial advisors that are underweight fixed income, overweight cash, trying to decide, when do I tip my toe back in the water? And when the Fed actually pauses, we tend to see very positive returns in fixed income. And we actually see the back end of the yield curve tend to decline even further when the Fed starts to pause. So I think what we're going to see is a lot of people, when they see the Fed start to pause, they feel a little more comfortable about the interest rate environment, and they're going to nudge those weights in fixed income back to where they should be.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from Advisor Perspectives every day, so why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member, and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. Underweight fixed income, overweight cash. We talked earlier about the need to be able to keep up with or exceed inflation. How should investors add inflation protection to their portfolios? What specific ETFs do you think offer the best opportunity to do that?
Yeah, this has been one of our hardest questions, because we haven't had to deal with inflation for so many years. So if we just take a step back, stocks are actually a great inflation hedge. But as we talked about earlier on the podcast, we don't know if there's going to be an upcoming recession. So it's really hard to go really overweight equities in this environment. But if we look at fixed income asset classes and which ones tend to perform best in inflationary environments, I'd say there's three sectors that you could focus in on. The first is TIPS, Treasury Inflation Protection Securities. We have a very large ETF, the ticker's TIP, which is the entire TIPS yield curve. However, it does have a duration of over 8 years. So some people who are talking about those real yields coming up, they might be a little bit concerned about that. So a more popular way to get exposure right now is through our shorter maturity TIP ETF, STIP, which is just 0 to 5 year TIPS and has about a 2-year duration. So that's been a really popular way to do it. The second category that does well in inflationary environments is actually high yield. High yield bonds tend to experience tighter credit spreads in this environment. They have some equity market, they have higher correlation to the equity market, so they tend to do well. So we've seen people with 8-9% yields in some on some high yield bonds right now. People adding them not only for income but for a little bit of inflation protection because that income can help buffer the impacts of inflation. And then I'd say a broad, easy ticker to trade is USHY, which is our iShares broad high yield corporate bond ETF that costs just 15 basis points. So it's a low cost way to access a broad series of corporate bonds. And then finally, I'd say floating rate securities. My one of my preferred tickers for this is our iShares floating rate bond ETF FLOT. It holds bonds that are all investment grade, and the coupons on those bonds are going to reset off a short-term interest rate. It used to be most of these bonds used to reset off of 3-month LIBOR, but actually this month is the cessation of the London interbank offer rate, so that rate will stop being published. Over the last few years, the entire market has really shifted to SOFR, the secured overnight funding rate, which is based on repurchase agreement transactions on treasuries, and it resets now daily. So these bonds used to reset quarterly. So when the Fed would hike, they would kind of, reset dates sprinkled through the quarter and they would reset. Now they're resetting immediately. So if the Fed is continuing to hike to combat inflation, you've basically got a suite of bonds whose coupon payments are going to increase right away. So I think that's a great way to step out of cash. And if you're not really sure, if your cash is keeping up with inflation, you could compare the yields on float to some other instruments and layer that in as part of a strategy to have something that's really short duration. The duration on it is, 0.02 years. It's very low at this point. However, it's offering, pretty high yields that are keeping up with those Fed hikes. So that would be a couple ways to do it is through tips, through high yield, or even through some floating rate.
One of the biggest trends in the world of ETFs has been active ETFs, and BlackRock recently launched a new active fixed income ETF. It's called the BlackRock Flexible Income ETF. Can you provide an overview of that fund and where do you see it fitting in the typical allocation that advisors are constructing for their clients?
We have a very long track record of managing active fixed income ETFs. We had two ETFs we launched 10 years ago, and they're hitting their 10-year track records this year. But this is our first, I'd say, more flexible fixed income ETF on the active side rather than just a short duration exposure vehicle. So our BlackRock Flexible Income Fund, the ticker is BINC, like BlackRock Income. It's going to be managed by our Chief Investment Officer, Rick Reeder, and it's really designed to be a flexible income strategy. So a lot of advisors, what we see them do is when they want to add income to portfolios, they stick to high yield corporate bonds, and relative to broad benchmarks, their portfolios are typically overweight high yield. So if you're looking for a way to diversify your income sleeve, this is going to be holding a range of income producing assets. So it's going to have some core sectors like corporate bonds, investment grade, and high yield, but it's also going to be able to access other categories like emerging market debt, collateralized loan obligations, and other income producing securities, and doing it in a risk controlled manner. So I think whenever we see people putting together income sleeves, sometimes it's hard to get started. It's hard to know which sectors make sense in which environment. And this one is going to be a more flexible strategy where it can allocate to the different sectors and is seeking an income of about 150 basis points above the Barclays Universal Index over time. So it is going to be an income seeking vehicle that is going to have some credit risk. But I think it's going to be a great vehicle to add some diversification to portfolios.
If there's one key takeaway that you'd like to leave with our audience of financial advisors about the key questions that they should ask to determine if their fixed income allocations are appropriate, what would that be?
I would just ask yourself, what do you want fixed income to do for you? We have a framework called the BlackRock Bond Pyramid. And just envision a pyramid, and the top of the pyramid, the top third of it is going to be for income. The middle section is going to be for capital preservation, and the bottom of it is going to be for equity market diversification. So if you just take a step back and say, what do I need fixed income to do for me? Do I want it to do a combination of those three things: income, capital preservation, or equity market diversification? If you've got really equity heavy portfolios, you've got younger, more aggressive clients, then you probably want your bonds to behave more like bonds. You want them to have more interest rate risk because that diversifies equity risk. You probably want to stick to high quality investment grade exposures. So you may just want to stick with a broad ticker like our aggregate ETF AGG, or even just treasury bonds. You can access those in a broad fund like GOVT. However, if you really want it for capital preservation, then you're probably going to need to stick to short duration. And so we're finding people using our short duration treasury products, anything kind of with a duration of maybe 2 years or less. It's not going to have a lot of volatility. You just want to collect some income and not have it move around too much on you. But then finally, if maybe you have older clients who don't have so many equities, they can actually conversely take on a little bit more economic risk in portfolios, and you have heavier income sleeves. Well, that's really where you can add things like high yield, emerging markets, preferreds, REITs, the Blackrock Flexible Income Fund. There's just a lot of different ways to do it. So I would just say take a step back, think about your holdings, think about your portfolios, how many stocks and bonds you have, and that framework can really help you map any existing fixed income investment, whether it's a mutual fund, an ETF, or a bond. And then it can help you think through, how much do I want to have in those different buckets? And if you're not sure, you could even plug your holdings into some of our tools on the Blackrock Advisor Center, and it will help diagnose how much risk you have within some of those different factors. And then you could tinker with the weights to get to an outcome. There's even a stress tester. So if you're worried about inflation, if you're worried about a recession, if you're worried about a big stock market downturn, you bulletproof your portfolios for some of these different scenarios.
Well, we will include a link for more information about BlackRock and its ETF lineup in the notes that accompany this podcast. There'll be a link to the recent iShares fixed income white paper, which is called The Great Reset. And I'll also put a link to those tools that you just mentioned on the BlackRock website where advisors can stress test their portfolios. Karen, is there anything else you'd like to add?
I'd say the only other big trend that we're seeing in fixed income are our term maturity ETFs, our I bonds. Those are ETFs that actually trade like stocks on the exchange. They are diversified like funds, but they have maturity dates like bonds. And we've seen over $6 billion of inflows into our I bonds this year. We now have them in treasuries, investment grade corporates, munis, and even high yield. And we have a laddering tool on our website where people can put together very scalable bond ladders using these. So that's another way that people are using ETFs to manage bond sleeves in a very scalable way.
What are the expense ratios on this?
They range from 7 basis points for the treasuries, 10 for the corporates, 18 for the munis, and 35 for high yield. So we try to be competitive with where a lot of SMAs are priced as well.
So that's a very cost-efficient way to build a diversified bond ladder. Well, thank you. And thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Karen Veraa of BlackRock. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.